What is it, though, about Bitcoin specifically versus other alternatives or, say, distributing extra cash?
Let's look at the big picture. I've been a public company officer for 22 years. When you could generate 5 to 6% short-term interest on Treasury and you thought that the cost of capital was 7%, then you didn't have to consider anything other than a conventional Treasury strategy. You're maybe taking a minus 2% yield per year. When conventional Treasury assets started yielding 2% and you had a cost of capital of 7%, which is the expansion of the money supply, it became a minus 5%. Grit their teeth and they got through it. That was for the past 4, 5, 6 years. Now in 2020, we've seen the cost of capital explode. It's 25% monetary supply expansion. The Treasury strategies are now 0, 1, less than 1%. So you've got a negative real yield, minus 25%. That's the cost of capital. That's actually turning up the heat that's causing everyone to realize that conventional Treasury strategies are broken. Now, what are you going to do? Look at the last 12 months ROI. Bitcoin is up 461%. S&P is up 25%. If you invested all of your Treasury assets in the SPDR, in the S&P index, you kept up with the cost of capital. NASDAQ's up 53%. Big tech, they're monopolies, they're extraordinary, they're staying ahead of the cost of capital. Treasuries down 7.7%. If you were holding long bonds like TLT, that's a disaster. Gold up 9%. It's also a disaster. It's not keeping up with the cost of capital. So why Bitcoin? Well, yeah, you can't hold conventional treasuries. You're looking at a negative real yield against the cost of capital of 15 to 25% a year, right? I mean, I'm not a consumer. I have to manage shareholder value. And if you want to maintain or grow shareholder value, you're going to have to grow your assets at a rate faster than the cost of capital. So your hurdle rate is 15%. Now, what are you going to do? Yeah, if you look,
I mean, it is a different definition of cost of capital that you have than, say, like a traditional accountant would have, right?
I don't think so. I think that a lot of people think about inflation. I think CPI. The cost of capital has always been, in a conventional environment, risk-free, 6, 7, 8%. If you talk to any institutional investor in the past decade and you said, my idea is I'm going to invest your money at 1% or 2% or 3% interest, they would ask for it back. In fact, there's not a single institutional investor that can keep limited partner capital by promising 1 or 2 or 3% returns. All investors know the cost of capital, it's about 7 or 8. Look, if you look at the compound annual growth rate of the S&P over a decade, it's 11.4% for the past decade. If you look at NASDAQ, it's faster, it's 17%. Big tech is better than the S&P. Look at the compound annual growth rate of Bitcoin for the decade, it's 198%. Okay, so why Bitcoin? I have to move my money. Look, you either got two choices: decapitalize the company or invest the money into something which is going to keep up with the cost of capital or exceed the cost of capital. So let's talk about giving the money back. Well, Joe, the road to serfdom would be for you to surrender all your assets and take a job working exponentially harder for cash, growing exponentially weaker. No family on earth would do that. No investor is going to give all their capital back to the limited partners, right? No endowment's going to work. No university, no company can function by surrendering all their capital and then working harder exponentially for a currency growing weaker. And one more point, the robots are taking over the country. We're automating everything. So for Amazon to succeed, 15,000 retailers are destroyed. For Google to succeed, 15,000 media companies are destroyed. For Apple to succeed, 15,000 device manufacturers are destroyed. Every company is competing against Google, Apple, Amazon, Facebook. These companies are dematerializing their products and they're shipping. Microsoft can bundle a product, ship it to 80 million companies over the weekend. How are you going to make money if you pretty much give up all your capital and you start working to create a new product to compete against Microsoft, Facebook, Amazon, Apple, or Google, when robots are taking over the world.
Let's break into a couple of things. So one question, of course, that people have about Bitcoin is, even though it has done very well, the track record speaks for itself. It is also, we know it's extremely volatile. Historically, it's suffered big drawdowns. We don't know when the next one is going to be. In 2017, it peaked around 20,000, got as low as 5,000 in March of last year. Is there anything good about holding Bitcoin itself if it's not going up? In other words, during these drawdown cycles, is there anything about the asset that makes it an attractive thing for you to hold?
First of all, it's the hardest money on earth. It's an institutional grade safe haven asset. It's gold without all the imperfections of gold on a digital monetary network that moves at the speed of light that you can program to do 1 million transactions a second. So Bitcoin is digital gold on a big tech monetary network. Why would you want it? You would want it for the same reason that you want to run electric power to your city, or you would want to run running water to your building, because civilization is based on clean energy, clean water, clean communications, clean money, right? It is an extraordinarily important thing. Now, with regard to companies, the real issue here is if every currency is correlated to the dollar, right? I mean, they're all trading against the dollar. So if the dollar is weakening, every other currency is weakening, and then every stock and bond and commercial piece of real estate that generates fiat or US dollar cash flows, or any cash flows in a fiat currency, they're all correlated assets, and they're all correlated ultimately to the dollar. So if we create 15% more dollars every year for the next 10 years,
right,
then you've got to discount the cash flows of every other instrument by 15% a year. And it doesn't take a rocket scientist to figure out that 80 to 90% of the value in those instruments is going to be collapsing if the dollar. If you want to preserve shareholder value, you have to buy scarce assets. Now, I could look for baseball cards or Picassos or sports teams, but it's hard to buy $1 billion of liquid, scarce trophy assets. So Bitcoin is the most liquid, scarce, uncorrelated asset that you can buy if you're trying to do this in a treasury.
But let me, you keep testing you on that, and we have a question from the audience about your measure of 15% cost of capital and so forth, and others might have it less, as you said in the past, 7 or 8%. But a company that someone typically invests in, a publicly traded company, they don't typically think of them as an investment trust, and they think, the real opportunity is not what they hold, but what they do. And lots of companies are doing well. I mean, you talked about the challenge of competing against Microsoft or Google or Amazon. There's numerous software companies, for example, that are listed that have had phenomenal years. Business is growing 50% year over year. For most businesses, don't people actually want to invest in the business itself as opposed to, say, some aspect of their capital structure?
Conventional treasury strategy is now intellectually and morally bankrupt, and it's a road to serfdom, right? And I think that what you're going to find is increasingly there's haves and have-nots, right? There's the elite that have incredible power, like the Googles and the Amazons and the Apples, and they have more money and more power and more distribution than God. And then you've got conventional businesses that have conventional cash flows, and they're being increasingly marginalized. So to ask those businesses to invest all their capital in a currency which is devaluing at 15% or 20% a year is pretty much committing economic suicide.
But the expectation,
again, it's the same thing as, why don't those investors give all their capital back to their limited partners and decapitalize under that strategy, right?
Yeah, but again, the expectation, I think, most investors is not that they're going to hold most of